U.S. economic data is out. The things disrupted by the shutdown are starting to cross the wires. The markets were anticipating them with great anxiety. So, have we learned anything? That's what we're going to explore here with the benefit of having seen at least the first batch of what's out there. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And what we're going to do here is see if we can't make sense of what this data was, what it may start to tell us or not tell us, whether it makes any kind of a difference for expectations for Fed monetary policy, which is, of course, the reason why anybody cares about any of this to begin with. So let's consider here, first and foremost, how these markets performed today. We'll take a look at what moved and why. And then perhaps that'll start to set the stage for the data that we saw, and then we'll go through it and see what insights we can glean. So we find ourselves finishing with some modest gains here, 0.4% up for the S&P, 0.97% up for the NASDAQ. And that's really a consequence of late day rallying that ultimately undid a much worse picture. At one stage here, the S&P was meaningfully lower than what we're seeing at this point. But with the benefit of sort of late day rallying here, we seem to have ended up with a better outcome. And at least in part here, this might be sort of a laddered reaction to just the data having not really produced much of anything. If we look across markets here, we find ultimately sogginess, but not a whole lot of follow through. And that really seems to run across the board. Yields a little bit lower, crude oil down, but that seems to be a story unto itself. Gold flat. The euro was up quite a bit, but then seemed to erase all of it. The yen still up, so the dollar on net a little bit weaker. Bitcoin up 2.2% here, but on the whole, not really a whole lot of conviction. But the sort of gaps and weirdness that we see in stock markets today, they ultimately look much more emphatic than they appear. In fact, if we take a look at the March contract here for NASDAQ and the March contract for the S&P, it's much less convincing, really, what's actually going on here. Because if you look at the continuous contracts, what you end up with is slight gains. If you look at the March contract in isolation, and of course we're getting very close to those contracts rolling over here, it's a little bit of a different picture. It's actually down on the day, and we'll update that here. That looks a little bit more like this, where you have slight weakness on the S&P. Looking at the contract where we will be rolling to, and basically flat on NASDAQ, everything else the same. So you have a situation here where there's the appearance of swings, but not really the kind of directional conviction that you'd want to see. As far as the data goes, what we really had our eye on here today was the NFP report and the backfill there. We end up with a November jobs gain of 64K. We end up with an October number, which is a partial number because of a lack of robust data collection at 105. And on the face of it, this seems to sort of endorse what Fed officials have been talking about. The essence of what Powell's argument has been really the entire time that we've kind of been in this rate cut mode, let's say from August at the Jackson Hole Symposium, where the stage was sort of set for this, and then later at the September onset of the rate cut cycle, the narrative has really been laser focused on, well, the balance of risks has changed in the labor market. And so that's what we're going to be responding to here. That's why we were not rushing to ease before. And this is why we're going to actually take some steps and get this thing going now. So with that in mind, we get seemingly what the Fed is looking for. I mean, we can see here with the naked eye that employment growth has clearly changed gear versus even what we saw here. So obviously things have been slowing down since these heady catch-up gains in the wake of COVID. But this decline here for October, this 105 decline, that ends up being the biggest move lower on employment since December 2020, which is, of course, the tail end of the COVID weirdness on the downside, followed in 2021 by COVID weirdness on the upside when we catch up after the lockdowns. And then since then, of course, we've moderated, and this now looks like we're starting to see something a little bit more sinister. Now, what's interesting here is recall what Powell said at the presser following the rate decision last week. He said, we think that at the headline, we're running at about 60K as an overcount. So if the overall number is averaging about 40K and the overcount is about 60, then on net, we're running at about a 20K loss for NFP per month on average. And this is sort of where we're beckoned into action. Now, consider what the net here is between October and November. We got down 105K here, up 64K here. It's about a 40K wash. And so this really just lines up exactly with what the Fed chair has been telling us. And so when we look at this then, does this really change the Powell established baseline? Well, ostensibly, no. The unemployment rate is a little bit higher here. This is the highest since September 2021 at 4.6%. But again, that was the point, really, of everything that the Fed has been saying so far. This was exactly the reasoning that the Fed deployed. And so while certainly these are the kinds of numbers that the markets maybe want to see, it's not exactly the kind of thing that engenders confidence. Because on the one hand, it doesn't really promise to deliver any more rate cuts than are already on the board, while at the same time it warns that maybe we're looking at some sort of an economic downturn that's starting to take shape. And you can kind of see that in the response from markets. Because one of the standouts here is NASDAQ, as we just saw, actually does relatively okay here. But it's the Russell, the small cap index, that takes the biggest hit. And that may very well be because there is a growth concern here. Nominally, rate cut expectations are a little bit higher today than they were yesterday, and only nominally so. If we take a look at what the outlook appears to be now, it's 58 basis points in rate cuts next year. That's a little bit higher than it was yesterday, where we were sitting at about 55, 56. So cautiously, this was interpreted as a tad dovish, but not so dovish that it really changes anything for anyone. And certainly in an environment where you have rate cut expectations acting as a kind of salve for markets, where they go, oh, good, rate cuts. For example, we've seen the Russell do exceedingly well around expectations for rate cuts when the conversation is, oh, well, the economy is doing fine, and then we're going to get rate cuts. That's good for small caps because it's good for the regional banks that hold a ton of government securities on their books. And of course, that was the trouble that Silicon Valley Bank ran into, and Signature Bank was they couldn't sell off those securities because after the 2022 Fed rate hike cycle, those securities are deeply underwater. They're nursing huge losses. And the idea is that those banks are going to be able to hold those things until they mature. And then those losses don't matter unless there's a run on the bank's deposits, which is what happened with SVB and Signature. And then you can't liquefy the holdings to turn them into cash because then you take huge losses, but you need the cash to pay depositors. You've got yourself a bank crisis. So when there's been rate cuts, which have helped to improve the P&L on those positions that the banks are holding, those bond positions mainly, that's been cheered on by Russell because it's been cheered on by the regional banks, which make up a significant portion of the index, because that just reduces their risk of a bank run that takes them out of business the way Signature and SVB saw in very clear relief. Now, when you get a situation like this, rate cuts expectations are a little bit higher, but the Russell sells off. Well, then whatever benefit to regional banks there is being subsumed by something. And when you consider that small caps are more vulnerable than cash-rich tech companies in an economic downturn, then you figure, well, if the Russell is doing poorly and the NASDAQ is relatively outperforming on a day when you have rate cut expectations even a little higher, that starts to smell like the markets are concerned about cyclical risk. Like there is a recession that might be in the offing at some point on the horizon. But for what it's worth, the differences are not meaningful enough that the Fed rate cut calculus has changed in any kind of particularly outsized way. It's a similar story when we keep going down the list of releases here. The last one for today that was of meaningful consequence was the retail sales report for October. And here, probably the thing that stands out the most when we start looking at the breakdown is this weakness in motor vehicle sales. Motor vehicle sales make up almost a quarter or a fifth, somewhere between there, of the overall retail sales basket. Makes sense, of course. It's a very expensive item to be bought at the retail level, a vehicle, oftentimes financed, of course. And so when you look then at what is going to move the needle on overall retail sales, vehicle sales is obviously a huge thing. And this decline of 1.62% in October, that's the kind of thing that makes you worried about consumer confidence. That's the kind of thing that makes you worried about the overall economy, because consumption, of course, makes up 68-ish% of overall GDP growth. Now, everything else is kind of a smattering. E-commerce is a big one. That's non-store retailers. We can see here things are relatively steady for food and drink, as well as for gasoline. Things are relatively even keel. No real big jumps there. A big jump in furniture, but that's not a really big component of the overall index. And in general, kind of merchandise sales, which would include this jump in sporting goods. It would include the jump, as we say, on the furniture side. All of that would sort of fall into the general merchandise category, which makes up about, let's call it 10 to 13% of the index. So huge that is not. But the drop in vehicle sales, that's something to keep an eye on. And finally, we got the S&P Global PMI updates. No big story there from Europe. A little bit warmer on the UK numbers than expected, but only by a hair. Probably doesn't alter the Bank of England calculus very much. Very near to expectations, a little bit softer for the Eurozone. Again, probably not anything that meaningfully alters the calculus, although at least in the case of the Eurozone, this is relatively weak, all things considered. If we kind of put this composite number in context, this is the weakest reading that we've seen for this since September. But the general heating up of the economy that we've seen over the course of the second half of the year in the Eurozone, that continues. At this point, we're looking at some of the warmest readings for economic growth that we've seen since back in the middle of last year. And even before that, sort of early 2024, end of 2023, as the Eurozone was trying to emerge out of what was essentially a technical recession. So we're looking at relatively steady readings here that don't seem to portend anything out of consensus when both the ECB and the Bank of England announce monetary policy later this week. The U.S. numbers are not terribly encouraging, a little bit weaker on the composite than expected, and that coming from the service sector. But again, this echoes what Powell has been telling us, which is to say that we're going to get continued disinflation in services, that most inflation now is coming from goods, which, according to him, is a pass-through and a one-time increase. Here's those PMI numbers for the U.S. And because of that, we are likely to see the good side of things rebase out by, let's say, April or so. And going forward from there, the Fed should feel itself vindicated in focusing on employment rather than inflation, because these elevated figures that we're looking at now, hovering around 3%, will have resolved. And that's really the essence of what seems to be coming up next here, because, of course, the next big item on the calendar, after a pause in heavy-duty data flow tomorrow, will be a look at U.S. CPI numbers on Thursday. But from the looks of it here, we're a little bit softer, but in the kind of way that the Fed would welcome. Now, as far as the relationship between policy expectations and markets, we can see we find stocks stalling now that Fed easing has stopped expanding in the forecast. And at this stage, we didn't get anything that would meaningfully alter where things are set. And that seems to present itself here, even with this little wiggle in a more dovish direction. Markets ultimately don't find that compelling. The dollar continues to edge down, but seems to be stabilizing a little. And of course, the biggest question now is, do we hold this bottom? Is this a down move that has now gone through adequate consolidation and we're going to break lower? Or maybe the other way around. Maybe this is a bottom that's forming before the dollar rallies. Unclear at this point, and probably something that's going to wait for a resolution in 2026. But for the moment, again, this data doesn't seem to really change the game very significantly. The Fed's still only expected to do one rate cut next year. That's probably the biggest disparity of all. The markets, as we can see here, think there's going to be at least twice that. And we're now 8 basis points in the direction of a third cut. That's still less than even odds, but higher than yesterday by 2 basis points. We'll see how that develops from here. In any case, the data that we've been looking at so far has painted a very similar picture. And we go back to those ISM figures that we've been using as a stand-in for U.S. economic data disrupted by the shutdown. And we can see here, relatively steady, probably averaging something like a 51 and change on a composite between services and manufacturing here, because services is a larger part of the economy. At about 51 and change, this would amount to relatively steady positive growth, of course, in the logic of PMIs, as ever. Over 50 is growth, under 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so manufacturing is in contraction, services is not, and is growing enough to offset the downdraft from manufacturing, such that we end up with modestly positive growth. We have employment that continues to shrink in both sectors. That would be beckoning Fed easing, and a view on prices where things are moderating, if not falling back to historical levels. So again, the Fed seems to be relatively validated by these numbers that we've seen so far this week as the catch-up data comes out, but only just, without really meaningful progress forward. So what does that mean for markets from here? Well, as far as positioning is concerned, I'm still a little bit long gold. I think that still looks like a trend that's developing and that has room to perhaps continue. We'll see. At this point, we're kind of consolidating against those highs that we saw in gold going back to mid-October or so, just around 4,400, give or take. We're pointedly not rallying here as we get the sort of day that we have in markets today, with yields lower and the dollar somewhat on a softer footing. But we also don't get a sell-off. And so gold still seemingly waiting for its catalyst. I'm a little bit long the pound and the euro here going into those monetary policy announcements later this week, on the idea that they're not going to do anything more dovish than is already anticipated, which is a standstill for the ECB and a rate cut for the Bank of England, which is already discounted. And that will be an unfavorable yield mix for the US dollar against those currencies, where the markets, again, still continue to speculate on more easing than the Fed is endorsing for now. So that maybe sets us up for some gains there. We still have the anti-risk exposure that I've been holding. The last bit of the put verticals in IBIT, that's helping things along. Of course, Bitcoin is a little bit higher today, but that's hardly a huge move here in Bitcoin terms, and we're still very much down and actually angling to be down for the year, which is unusual. And still have my sort of slight downside exposure on risk via stocks. I put vertical in the NASDAQ. I put vertical in the S&P. A little bit of progress here and not a lot of progress there today. That is to say, a little bit of progress on the S&P, not a lot of progress on the NASDAQ. But nevertheless, the structure seems unchanged, and it seems like the markets really just got through event risk. That, of course, is exactly what we talked about when we considered this yesterday and said, look, as we look at this week of economic data, chances are we maybe don't get anything earth-changing. And if we don't, then we get back to what the markets resolved when they sold off on Friday in the wake of the Fed meeting. That is to say, they didn't like ultimately that there's only one rate cut here and want more, clearly. And even though the Fed restarted short-term asset purchases to re-anchor borrowing costs in money markets, and it took the market seemingly a good 48 hours almost to figure out whether they're happier about that than they are upset about the rate cuts outlook. On Friday, we got a resolution. And it turned out the markets were more upset that they didn't get enough cuts. If we continue to see the kind of thing we saw today, which is economic data that doesn't dislodge that consensus, then after we get through all of this event risk, one might think the resolution is the same. And so we might be looking at another late week sell-off, provided CPI data on Thursday is going to comply. That's Macro Money for today. As ever, we are here Monday through Thursday, right after overtime. That's a show I co-host with Chris Vecchio, looking at the Wall Street close and where things might go therefrom. I am likewise commenting at Ilya Spivak on former Twitter and on Blue Sky, writing for the news and insights portion of tastylive.com. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.